Hi, this is Ankur Kapoor. Today we'll be talking about principles of investing. These are universal principles, can be applied anywhere in the world, including any industry for that matter. These are fundamental rules of investing. What's the first rule? The first rule is investment and speculation. You need to know the difference. What really defines the difference? The first is it should be based on thorough analysis. If you have not done proper research, that can't be classified as investing. It's purely speculative. Second is there should be adequate coverage for the principal. Basically means that your capital should be preserved. Your analysis should indicate that irrespective of whatever happens in the future, there will not be any loss to the capital. Third is you should be aiming for an adequate return. This adequate return is a very subjective topic. The only thing that you need to understand here is you should not get swayed by the recent returns in the markets or in a particular stock or industry. Rather, it should be based on some fundamental rules. I would say 5% more than the inflation in the economy should be the first target. So that will basically mean if the inflation is around 5% you add to that. So I'm saying 10-11% should be the return expectation in Indian context. The second rule of investing is you have to think like a business person. You should not be thinking only for the small number of shares you're purchasing. Rather, you should be looking at the whole company, what management is doing, what kind of actions they are doing, taking in terms of capital allocation, corporate governance, and other policies that company is framing. You should not be thinking as a small investor, rather as if you are investing in the whole company. The third rule of investing is use this stock fluctuation to your advantage. So in short term, there can be pessimism or optimism. Use this pessimism or optimism situation to your advantage, which basically means when the market is in negative mood, invest. When the market is euphoric, extremely positive, sell. The fourth rule of investing is value. Often this value is a debatable term and people look for precise numbers. You don't have to. As far as you have a particular range or broad understanding and you're able to define whether a particular number is adequate or not, that should be the focus. It should not be precise numbers. No one in the world has been able to figure out what's the precise number. So it's not an exercise that will have a very great payback. So what this means is basically if a particular price of the stock is 100 rupees, you should be able to tell whether that 100 rupees is cheap or not. You need not get into the understanding whether it is 120, 130 is the fair value. As far as you understand that 100 is cheap, that should be good enough. And usually when it happens is, let's say your assessment or your broad understanding is it should be upwards of 200 rupees. Then 100 rupees is cheap, whether it's 110 or 120, or on the other side 90 or 80, it can't be commented. Your assumptions could be wrong. So there has to be a comfort on the adequacy of the value. That value should be more than the price you pay. Fifth point is an extension of our fourth point, that is margin of safety. I'll extend the same example. If you arrive at a fair value of a company as 200 and the current price is 100, there is a 50% margin of safety. Similarly, let's say your assessment is instead of 200, it's 120. The margin of safety is only 10%. So when we say there has to be sufficient margin of safety when you make an investment call, we basically mean the difference has to be as high as possible. A 10% difference between the price and the value may not be justified. That's why both the points are linked. There has to be a sense of value, and that sense of value and the current price, there has to be good difference. Sixth principle is you have to think independently. You have to think on your own terms. You can't be driven by what media is feeding you or what your friend is telling you. You have to be driven by your own assessment. As far as that independent thinking is there, you should be able to make wise investment decision. So I'll summarize 6 principles. The first is investment and speculation. You should be clear that you're doing investment. Second is you have to ensure that you're thinking as if you're buying the whole business. Third principle is you have to use stock price fluctuation to your advantage. Fourth point is you have to understand a fair value of the company. Adequate fair value is good enough. Fifth is you have to have sufficient margin of safety. And the last principle is you have to think independently and not swayed by narratives feed it to you in different forms. I hope you like the video. Thank you for watching.